know the strategy. You've known it for years. Buy low, sell high, diversify, stick to the plan. So why are you still losing money? This isn't a rhetorical question. It's the most important question in personal finance. And almost no one asks it seriously. The answer isn't a better broker. It isn't a smarter algorithm. And it isn't the newsletter you haven't subscribed to yet. The answer resides behind your eyes. It works quietly in the background, sabotaging every rational decision you try to make. Your psychology costs you more than your fees, more than your bad trades, more than inflation, more than anything the market has ever done to you. This video won't give you a stock tip. It won't give you a magic formula. It will give you something far more valuable than that. In 2021, the financial research firm Dalbar released its annual report on investor behavior. What they found should have been front-page news everywhere. The same market, completely different results. The gap wasn't caused by bad funds. It was caused by bad timing. Investors were buying after prices rose and selling after they fell. They do the opposite of what they know they should do. Not because they lack information, but because their emotions move faster than their logic. This gap has a name. Behavioral economists call it the behavior gap. This term was popularized by financial planner Carl Richards, and it's not a small error to be ignored. Over decades, this difference in returns compounds into a chasm. It is the difference between retiring with comfort and retiring with anxiety. The difference between financial independence and financial dependence. And it resides entirely inside your head. So how does this happen? Your brain wasn't built for the stock market. That's not an insult. That's neuroscience. The human brain evolved over hundreds of thousands of years in environments where threats were immediate and physical. Rustling in the grass meant a predator. Hesitation meant death. The brain learned to react quickly, and it learned that losing is more dangerous than gaining is rewarding. Psychologists Daniel Kahneman and Amos Tversky spent decades documenting this disparity. Their research proved that the pain of losing a sum of money is psychologically twice as powerful as the pleasure of gaining the same amount. They called this loss aversion. When the market drops 10%, your ancient brain doesn't see a temporary pullback in a long-term uptrend. It sees rustling in the grass. It sees danger, so it sends a signal that is almost physical in its urgency. Do something. Get out. Protect yourself. So you sell. You lock in your loss. You exit the market at the worst possible moment. Then you wait too long before getting back in. Because the fear has now turned into paralysis. And by the time you finally return, you've missed the recovery. This isn't weakness. This is biology. But biology is not destiny. What they have is a different relationship with their emotional reactions. They have trained themselves to recognize the signal of fear and pause before acting on it. That moment of pause is worth more than any stock tip you will ever receive. Researcher Brad Klontz, a financial psychologist, identifies what he calls money scripts. These are unconscious beliefs about money that were formed in you during your childhood. These scripts operate beneath the surface of your conscious mind. They shape how you feel when you open your investment portfolio. They determine whether you associate money with security or danger. Klontz found that many destructive financial behaviors, from compulsive spending to pathological hoarding to complete avoidance of money, trace back to these early scripts. The market doesn't create your fear. It only activates the fear that was already there, which means fixing your investment strategy without fixing your psychology is exactly like trying to drive with one foot on the brake the whole time. Think about what happens in a bull market. Everything is rising. Your friends are talking about their returns at dinner. Your neighbor bought real estate. You read about someone who turned $20,000 into $400,000. The feeling that spreads through you in that moment isn't exactly greed. It's something older and more social. It's the fear of being left behind. Economists call it FOMO, but the academic term is herd behavior. It has been documented in markets for centuries. From tulip mania in 17th century Holland to the dot-com bubble to cryptocurrency cycles, the pattern is identical every time. People follow the herd not because they've evaluated the fundamentals, but because standing outside the herd feels psychologically unbearable. Then comes the correction. And the same social pressure works in the opposite direction. Now everyone is warning you. Articles about the crash, news about the catastrophe, and the brain follows the herd again. Exit, drop, gone. What does doing something different look like? Investors who navigate this cycle successfully share specific habits. First, they decide in advance. They write their investment plan when they are calm, not when they are reacting to events. They determine in advance what conditions will cause them to rebalance and what percentage drop they are prepared to endure. They set rules for their future emotional selves because they know that their future emotional self cannot be trusted to set those rules in the heat of the moment. This is called a pre-commitment strategy, and research consistently shows that those who use it make better financial decisions in the long run, regardless of how smart they are. Second, they control their information environment. The financial media ecosystem is built to generate anxiety. It lives on your attention, and your attention is captured most reliably by fear. Every headline about a market crash, every news clip, every social media post is a little shot of cortisol into your bloodstream. And cortisol makes you react instead of think. The best performing investors over time are often those who check their portfolios with the lowest frequency and consume financial news with the highest level of skepticism. This isn't ignorance, this is discipline. Third, they understand the difference between volatility and loss. This distinction is everything. A drop in the paper value of your portfolio is not a loss, it is volatility. It only becomes a loss when you sell. Those who did nothing, who looked the other way, who chose boredom over action, are the ones who won. Their discipline looked like laziness. In reality, it was the hardest thing the human brain could do in the face of perceived danger. This is the real work of investing. Not research, not building the portfolio, not tax optimization. The real work is an ongoing project to understand yourself enough to avoid destroying what you've built. Every trick you've read about investing assumes the problem is the strategy. But you know the strategy. You've always known it. The problem is the gap between knowledge and action. And that gap isn't bridged by information. It's bridged by self-knowledge. So the question worth thinking about tonight isn't which stock you should buy or which fund has the best expense ratio. The question is, what does money mean to you on a very deep level that you've never said out loud before? You knew the strategy. Now you know why it was never enough. If you found this helpful, subscribe to the channel because the next video